it's Arjun. As all of you that have been watching our video podcasts or reading our written work over the years by now surely know, our focus at Super Spiked and Veriten is on trying to understand the long-term outlook for energy macro and crude oil markets and all other forms of energy. And we have tried our best, and it has been no desire on our part to engage in the short-term oil price guessing game that so many others spend a lot of time on. But in recent weeks, we of course have been weighing in on what we think has been excessively bearish near-term sentiment around crude oil markets, the so-called oil glut that everyone is broadly expecting and forecasting, and how we think it's been leading to an excessively bearish sentiment around especially energy equities. It's really been since so-called Liberation Day, the tariff announcements in early April, that bearish impact, the perceived bearish impact of that on oil demand, coupled with what at the time was also the start of a more aggressive unwind of OPEC quotas, those two factors have contributed to this kind of overwhelming bearish sentiment we see out there, and numerous calls by many high-profile forecasters that we're going to be flooded with oil and it's going to drive prices to around $50 a barrel or potentially lower. It is now 5.5 months since Liberation Day. And in fact, OPEC has more aggressively unwound their quotas relative to what they announced back in early April. And at least so far, 5.5 months into it, crude oil prices have been far more resilient. They're actually up from that April 2nd low than what everyone has expected. And we addressed this in a written post last week that I would encourage people who didn't see it to find on either the Veriten or Super Spike websites, where we linked a lot of this sort of excessive bearish near-term sentiment on a lot of the same factors that we have long talked about, which is the, I think, overly bearish long-term view of especially oil demand. Our view is that there's no such thing as peak oil demand. No one knows what year, let alone decade, maybe even century oil demand might peak. And it's been obviously a core feature of what we've done. The biggest point of difference, I hate to use the word error, but the biggest point of difference is like everyone baselines the IEA's oil market report. And it's a totally fine report, but it is leading to an excessively bearish conclusion. And we highlighted last week that OPEC research actually has still some modest oversupply, but overall much tighter crude oil balances than what you would find in the IEA report. And it is that sort of baselining and relying on the IEA that is really causing these oil glut fears. We want to follow up this week to set the record straight on a couple items. We want to address some pushback from last week's written post and also raise some new points about both the near and long-term oil outlook. And there are 4 major areas we're going to discuss. The first is, how are we thinking about the OPEC plus quota unwind? Why did it happen? What's going on there? Second, comment on China oil demand. Third, the role of US shale going forward. And fourth, is there a chance that the oil bears calling for an oil glut might yet still be proven correct? And with that, let's get into the video. So I want to start off by discussing why has OPEC plus chosen to unwind its voluntary quota cuts and production cuts at a time of generally perceived softness in oil markets. And the first reason many offered, this goes back to early April, but that somehow OPEC plus and its core producers, which would be Saudi Arabia, UAE, and others, Kuwait, were reacting to overproduction and quota violations from Kazakhstan. We always found the blame Kazakhstan explanation to be preposterous. It is ridiculous. Pull up any graph of long-term Kazakhstani production, and I defy you to show where it has mattered at all. It's been part of non-OPEC. I still think about it in those terms, even though they are part of the declaration of commitments, of cooperation, excuse me. But the biggest driver of Kazakhstan production was the long-expected Tengiz expansion project being pursued by Chevron and ExxonMobil. That project actually came on, I think, a little later than it was initially expected. And the idea that known project is the reason that OPEC Plus got so mad that they decided to aggressively unwind their quotas, it's laughable when you say it out loud. So the sort of blame, now I will say this, actual OPEC quotas, as I've come to understand it, are a very sensitive issue within OPEC. So the idea that Kazakhstan should have just simply been given a higher quota, well, that unlocks Pandora's box for a whole bunch of other countries. And I think as a Wall Street analyst, which I'd still is how I view my mindset, we'd say, hey, just be realistic. Here's where Iraq is, here's where Iran is, here's where Saudi is, here's where Kazakhstan is. That is not the way it works within the OPEC plus countries. It is a highly sensitive issue. The idea that Kazakhstan should have been given a higher quota, that was not how things were going to play out. But the idea that oil market observers somehow viewed OPEC plus as being mad at Kazakhstan, give me a break. It has always been laughable. We, in early April, called it pump for Trump. We observed, US obviously has a new administration. President Trump has been very vocal about drill baby drill, and he wants to see $50 oil. Not sure those two things go together, but that's for another video. And that this was a way to tame inflation, which has been obviously a major concern here in the US. And I will say that with 5.5 months of hindsight, I do not think, while the slogan's catchy, I do not think we were right as that being the driver. So I'd like to say, I think others were wrong about blaming Kazakhstan. I'm going to say that I was wrong about the pump for Trump slogan I came up with. It is catchy, and there probably was some appeal to that. And I will say there clearly was an ancillary benefit, I believe, of Secretary Wright and President Trump went over to the Middle East in early April. And I think the major Middle East producers being able to tell President Trump, hey, we're doing our part to help your inflation problem. I think that was a message they were happy to deliver, but I no longer believe pump for Trump was the major driver of the quota unwind. I've tried to come up with a catchy new slogan. I don't think it's that great. Pump for glee for Xi. We now have, I think, undisputed evidence that the higher production from the quota unwind has basically gone into China's strategic petroleum reserve. And OPEC essentially chose to more aggressively unwind their quotas at a time China clearly has demonstrated, and we will guess expressed, a desire to build their strategic petroleum reserves. Now, I'm going to come back to this in the next slide, but this was all done at a time of a perceived massive oil glut. I'm going to get into this idea that the bears are now using this as an excuse for why the glut has not materialized, but I think the timing is interesting, and I would suspect that what you've seen here is a shift of underground OPEC volumes to Chinese strategic petroleum reserves. And as someone who has been in this business for 33 years, my colleagues at Goldman who still have access to the research portal can probably show a long documentation of all the calls I've gotten wrong. And the issue is when you have the high profile call and it starts to not go your way. For example, everyone making this oil glut, oil is going to fall to 50 call, you start making excuses. And I think the China SPR bill, to me, it's striking me as an excuse used by bears for why we haven't seen the oil glut show up yet. The line that's used is that visible OECD inventories are still generally pretty low. They've built a little bit, and that most of the glut went to China. The thing is, that China SPR bill is in fact visible. Everybody has the picture. I don't even subscribe to Kepler, which I think is one of the big sources. And I've seen this picture produced 1,000 times that here's China's inventory draw in Q1, here's the build in Q2. Everybody sees it. So to say this is an excuse for why you don't have an oil glut, I'm going to call that an excuse. And what it reminds me of, what it is reminding me of, is that early 2000 period. When I go back to Goldman's first top projects report, we, like everybody else, had a pretty big non-OPEC build for, I'm going to get my years off here, 2002, 2003. And in the first year, there were some hurricanes that caused non-OPEC supply to basically not grow instead of growing to 3%. The next year, there was some civil strife in Nigeria or some other country that again caused the non-OPEC growth, the oil glut we were expecting back then, to not materialize. And at some point we said, hey, wait a minute, we got to stop making excuses. And that led to our super spike call, where we went back in and said, what do we get wrong about this? We can't keep blaming so-called one-off events. And people are treating this China SPR as a one-off event. And the bears could still be right. We'll allow for that. But it is reminding me a lot of that era, of the excuse making for an oil glut that is not materializing. And let me go to the next slide to address this further. We have to ask, at a time where the death of Chinese oil demand has been widely expected, has that death in fact been greatly exaggerated? China, by all accounts, drew inventories in the first quarter, and then they built them by a greater amount in the second quarter. Why would they do that? Why going into the second quarter, and I don't know that China had some perfect information about Liberation Day coming and what it was going to mean. There clearly was an agreement to facilitate some transfer of OPEC spare capacity to Chinese strategic petroleum reserves. Why? When everyone was expecting an oil glut, even before the quota unwind. Remember, people were bearish before the quota unwind, and now they're super bearish because the quotas are being unwind. Why wouldn't China have waited for oil to have crashed further? By all accounts, whether it's oil, whether it's copper, whether it's any other commodity, the Chinese government and the people who buy on behalf of the Chinese government, they're viewed as smart buyers. They're viewed as people who generally buy when commodity prices are low, no matter what commodity is, and they don't buy or perhaps even sell into periods of strength. They're viewed as good traders. They clearly are a major source of demand in a lot of different areas. Why would they have bought? Why would they have indicated an intention to buy before the glut materialized? It's a big question. We are at a time where even we are guilty of this. I'm not absolving myself of any guilt here, where we have agreed, hey, isn't China's demographics kind of poor? I think they have declining population. Their property market, they probably overbuilt, and there's some debt issues and therefore some economic challenges they're facing. They have ramped up electric vehicles. They have ramped up LNG trucks and marine transport of LNG. Aren't all these things going to mean the sort of old days of China being a dominant driver of oil demand are going away? And while the debate was really, is China demand going to decline? Is it going to plateau, maybe grind higher? But everyone, including us, again, including me, have generally been bearish to it's going to be not an important driver of oil demand going forward. Why, given that outlook, why is China building their SPR further? They already have a lot of oil in their SPR. Yes, they still import, well over 10 million barrels a day of oil. That's not a small amount. But what is China seeing within their economy or within their usage of oil and expected usage of oil that they felt a sense of urgency at a time where everyone is generally expecting an oil glut, where everyone's saying OPEC has a lot of spare capacity? They felt the need ahead of that to actually further build up the SPR. And what does that say about Chinese oil demand? Are we all being too bearish on its outlook? So we have to ask ourselves, who has a better grasp on Chinese oil demand? Is it the IEA and Wall Street analysts, and I include myself in that group? Do we better understand China? Or do the OPEC plus leaders of Saudi, UAE, and Kuwait better understand China? Who has been more right here? OPEC chose to unwind their quota. Most people said, you're wrong to do that. And in fact, China's absorbed it. Who do we think has the better knowledge of it? And are we sure we are all following the correct sources when we build these supply demand models? This is the point of last week's written post in part, and I'm going to extend that point today. And the related question is, why wasn't China simply comfortable with OPEC retaining their perceived substantial spare capacity? Do they doubt the spare capacity? And in a world where there is high-profile tensions between, say, the United States and the Chinese government around trade and a bunch of other issues, I thought they were cozying up to countries like Russia and so forth. Why didn't they trust that production to be there for them? They're still a big market, even if you thought it was mature. Why were they not comfortable with the perceived OPEC spare capacity? And where is the critical analysis of all these questions? I'm not telling anyone you're wrong to be bearish. I'm saying please address this instead of using China built their SPR so it didn't show up in the OECD and that's my excuse for my call didn't work out. I'm encouraging people to do the same work we did in 2002 and 2003 when we were wrong, when I was wrong about believing in massive non-OPEC oversupply and an oil glut at that time. More critical analysis, please. The related topic I want to talk about is the alleged peak of US shale oil, because it's a super interesting time. Two of the biggest drivers of demand and supply, China and US shale. People have of the view that both are peaking, and China's going to be flat or down on their oil demand, and US shale is going to be flat or down on its oil supply. And it's quite possible we're wrong on both counts, actually. And our own views have been, I would say, closer to consensus on the Chinese oil demand point. We've thought it was mature, but we had a sort of a flat to grind higher going forward versus a decline. But I'm going to say I was reasonably close to consensus, and I'm starting to re-examine whether I was correct on that. On the shale supply, our view has been price dependent. If oil is above $75, it grows. If it's below 60, it falls. The days of shale just cranking out 1 million barrels a day of growth are behind us, but we probably had a little more optimistic view in terms of the ability to grow for US shale oil supply than maybe consensus, and that has been our view. And what I think is interesting about this current environment is that on the one hand, you have China adding to strategic oil reserves when oil has been below $65 a barrel. And Saudi, UAE, and Kuwait, and OPEC Plus in general, or at least the Great Eight, contributing to meeting that desired demand. I think shale grows if what we had $75 to $80 oil and people really believed in it. I think my opinion is you'll see the rig count go back up and people will figure out how to commercialize tier 2 and tier 3 resource. We can debate the timing of that a little bit, but I think there is a substantial oil resource in shale. And if the price incentive comes back, you will see that resource get developed. So the two biggest sources of demand growth and supply growth, which we've all debating on the relative timing of when each matures and rolls over, there might be a health to both of these things. And you have a bounding on oil prices that I will say is better. It's a more bullish bounding than that consensus, we're in a massive oil glut and going to $50 and potentially staying there for a little bit. I will say that, at least so far, it is Saudi Arabia, it is the United Arab Emirates, and it is Kuwait that have been the counterbalance in oil markets. I'm going to call Russia, Iraq, and Iran wildcards, where there are debates on their ability to continue to grow supply. We have a colleague here at Veriten. He's, I think, full-time at Rice, spends some of his time with us, Gabe Collins, who is fluent in Russian, a Russian expert, who's been doing a lot of good work on, are there some growing signs that Russia is maturing? I'm very fortunate at Columbia Center on Global Energy Policy to get to work with the great Tatiana Mitrova, who is a Russia energy expert. She too increasingly is asking the question of the war with Ukraine has been going on for 3.5, 4 years. There's been a little bit of insufficient capital going back into the sector. When will that start materializing in their forward supply outlook? So two leading Russian experts are asking the questions of, is Russia maturing? The countries that I think can still act as, quote, swing suppliers, I never really like that term. It deserves its own discussion that I'm not going to do today. But they're just 3 countries. It's Saudi, UAE, and to some degree, Kuwait as well. I will say this, historically, I've not necessarily been a big OPEC person. I don't know that all those views are publicly out there or not, but I've been skeptical of it. They're acting to some degree still a bit like a swing supplier. And I think the question you'd ask is, if China was going to build its SPR, why didn't they let them do that without unwinding their quotas? Wouldn't that have led oil prices back to 75 to 80? So at face value, if OPEC was targeting higher prices, if they were targeting that, wouldn't it have made sense to have surprised the market with sort of, hey, China built their SPR and inventories actually didn't fall anymore, inventories didn't build and they drew or what have you. You can argue that at a time of concern about the global economic outlook, OPEC, at least those 3 countries, Saudi, UAE, and Kuwait, have acted as a source of stabilization. Some of you will say you're giving them too much credit. Maybe I am. I'm just looking at the data and saying they could have let China just buy the oil and would have surprised the market very bullishly. And in fact, they've sought to meet that incremental demand from China at a time of economic uncertainty, where undoubtedly, for the benefit of global economic health, a slightly low oil price right now is better than a slightly higher oil price. So we'll come back to those topics in future posts and videos. It deserves some further elaboration than what I'm going to do today. The final topic I want to address is, will the oil glut bears? They weren't right in 2Q. They were not right in 3Q. Will they be correct in the fourth quarter of 2025? And I will say that if we ever get this long forecast, though yet to arrive, US or global recession, oil could absolutely fall to $50 a barrel. We've never discounted it as a risk. Our general advice to companies has been you should always be prepared for a downdraft in oil. You should run a balance sheet and run a CapEx program as if you could see $50 oil for 12 months. I view that as a prudent balance sheet and risk management, and that advice remains. And I will say this, if it is recession that causes oil to crash and for a quote oil glut to materialize, the bears will be right. No one has to, they would have been off by a couple quarters perhaps, but I'll say they're right. The exact reasons don't matter. If oil goes there and that was their forecast, we will be the first ones to say, you did turn out to be correct. And again, we shall see. The question I do wonder about is, why is everyone so dismissive of OPEC research's higher absolute level of liquids demand and the growth therefrom, in which so far between the IEA and OPEC research is more closely aligning with the actual development we've seen in oil markets. And what I was struck by, and I don't remember who did this, someone replied either to me on Twitter or on Substack, said, hey, go check out the Energy Institute's liquids number. And so I've done that. The Energy Institute used to be the BP Statistical Review of World Energy. BP sold it to the Energy Institute. And here is a comparison of the Energy Institute's oil demand numbers and OPEC's demand numbers to the IEA. And I apologize that I've only got this OPEC series going back to 2020. I'm just going to ask for forgiveness on that at this moment. We'll take it. We have it further back. We don't have it on this graph. And so treating the IEA as the baseline, what I find interesting is, first on OPEC, I've already talked about this. Since 2023, their absolute level and their growth rate for liquids demand has been kind of noticeably above the IEA's, and most people have been dismissive of it. Look at the Energy Institute. Again, this used to be BP, it's now the Energy Institute. Since 2016, they've had about 1 million barrels a day of higher liquids demand. And also in 2023, suddenly that increment shot up even higher to like 1.6, I think it's 1.6 or 1.7 million barrels a day of higher liquids demand than what the IEA shows. So you got 2 out of 3 forecasters on the sort of more on the higher side of liquids demand, which is better matching up with the balances we are seeing, where we don't have to make the excuse, oh, it's oil on water, which always goes up and down, or this sanction or that sanction didn't happen, or oh, China, major oil importer, decided to buy more oil, and that surprised us. You don't have to make excuses if you follow multiple data sources and figure out what is lining up here. We'll continue to dive in and do more than this, but it's not just OPEC research. I don't understand why people are, even oil companies I find, are kind of surprisingly dismissive of OPEC research. And here you have the Energy Institute higher than OPEC. So let me say this, forecasting short-term oil prices is really, really hard. And we are super grateful that we don't do that anymore for a living. And we have no intentions of starting today or I guess last week. So I will say, and I think it's reasonable pushback to come my way, which is, are you being too cute in calling out, you're kind of pushed back on the oil glut view, but you're not actually offering up your own specific price forecast? And let me address that. Our job, my job at Veriten, at Super Spiked, is we try and help companies think through long-term strategy. How can you be a great company looking out over the next 10 years? What is the macro backdrop that we should be thinking about? What are the risks you should take into account? What are the new areas you should get into and what are the new areas you shouldn't get into? It is all focused on the long term. I don't believe saying that oil is going to be 55 this quarter and 75 next quarter is the way to manage a company. It is scenarios, it is probabilities, and it is a sense of what kind of macro environment are we going to be in. So I'm going to say it this way. If everyone is base casing some oil glut that takes oil to $50, and that's their base case. So think of a probability distribution curve. That's the harder distribution curve. I'm going to say that is way too high of a probability to put on it. I'm going to say it's a tail risk that oil kind of crashes to 50 and stays there for a little bit. So I'm going to inherently place a much lower weight on it. I don't believe having quarterly oil price forecasts means anything to anyone. I really don't. I think I'm going to look at, I should always be prepared for $50 oil, but I'm going to say the probabilities of it are low. When I think about that bounding of oil prices, which we're going to call 60 to 65 at the low end, where China's coming into the market, and that $75 to $80 plus, I do think that is a good bounding in an environment where global GDP growth is lackluster. But I think that curve, that band, does start shifting to the upside. And what is getting me there is the recognition that I think oil demand is already much healthier than what everyone perceives. So I've been in that super vol, not super cycle. I've always said super vol, not super cycle. I keep saying that. But a lot of that was bounded in China's super mature, and maybe the oil demand is going to be flat. And how much confidence do we have, or what's the timing of other areas, India, et cetera, of sort of taking over the mantle? And it is the African numbers, which I've mentioned enough times now, that are giving me more hope. If you look at global oil demand from other sources other than the IEA, there's a bunch of oil demand growth in liquids and oil. I want to be clear, in a bunch of other areas: Africa, Latin America, the Middle East, India, and other Southeast Asia. That's most of the world. And hey, guess what? The OECD looks flat. It doesn't look down. And so when I think about that sort of bounded super vol, we're going to go here and we're going to occasionally go up here, the risks are increasingly moving to the upside on that. We do have to get through the fourth quarter of this year. I'm not going to, I'll save that as, I think the last shot for the bears to be right, if you will. But I think we are moving into an environment where, especially if China oil demand is going to keep contributing to global liquids and oil demand growth, we are going to be starting to move into phases where that risk reward is skewed to the upside. At the barest of minimums, sentiment structurally and cyclically is way too bearish from a likelihood of occurrence standpoint, and risk to me is skewed to the upside for sector sentiment, and inevitably, once we get through this period, to oil prices as well. So I'll end this video on a personal note. I am recording this video on September 11th, which as someone who lived in New York on that awful day, I've always said it is the worst day of my career. And I try and keep these on a personal notes to be upbeat, and it's about my golf game or living with my parents and fun stuff like that. But it's always a somber day. And I'm recording this on September 11th. It also happens to be the day after a pretty dramatic political assassination in the United States. I've also said at Super Spiked, our focus is on energy. It's not on other issues. We talk about politics or geopolitics as it relates to energy supply demand balances. We try not to get engaged in American culture war issues. I mean, my personal opinion on any of this stuff is not relevant to Super Spiked or the work we do at Veriten. But this is the on a personal note section. I thought the news yesterday was just devastating. 31 years old, young family, 2 young kids, and the style of engagement, the segment Charlie Kirk was working on was called Prove Me Wrong. That's very much the spirit of how we approach Super Spiked, which is, I don't claim at all to be right about anything. And I'm actually not even trying to convince you of my views as, quote, the correct views. I love the discussion and debate. I want people to push back and say, Arjun, you're still giving too much credit to OPEC or not enough credit to China or whatever the case may be. I love the pushback. Prove me wrong. It is the spirit by which I try and apply to Super Spiked. And, on September 11th, we all walked up the FDR evacuating Wall Street. I went to New York Presbyterian Hospital where my wife was pregnant with our first child. My kids are now just out of college. I've still one in college. And that was Charlie's target audience. He'd go to universities, put a mic up. The segment was Prove Me Wrong, and he'd encourage people to ask him questions. Some agreed with him, some disagreed with him, but it was that spirit of let's have a dialogue and discussion about it. So I got to figure out a way to end this on a more positive note. It is a somber day, and maybe we're just going to have to lean into that, at least for today, and we will do our best to be more positive in a future on a personal note. And I do wish everyone the best. Thank you.